Welcome back to the Dutch Investors. Today's guest had a front row seat at the Asia's economic rise over the past few decades. He's advised investors to multinationals, spent over 20 years as the chief economist and head of research, and please correct me if I'm wrong later, for Asia Pacific at Deutsche Bank. And he now runs his own Substack, Temple Street Advisors. It's a very insightful newsletter, and I'm very excited to welcome him here. So, Michael Spencer, welcome to the show.
Thank you very much, Seem. Thanks for the invitation to join you on your podcast.
I'm excited to talk to you as well. I think you'll have some unique insights. It's not every day I talk to someone with the expertise you have, especially focused on Asia. And it's a market we're very interested in learning more about. So, before we get into all the questions around China and Asia, equities, macros, whatever it may be, I'd love to hear a bit about you. So let's start at the beginning. How did you get into economics and investing yourself?
Well, in my experience, there are two types of economists. There are failed physicists and failed historians, and I'm in the second camp. So failed physicists are people with a strong mathematical bias who are attracted to the idea of using statistics and models and mathematics to try to understand this very complicated thing we call the world and economics and people as they behave as economic agents. And then there are people like me who were attracted into economics because it provides a more rigorous way to tell stories about the world. Economics training essentially just gives you a set of tools to understand the world in a different way from somebody who's maybe an anthropologist or a traditional historian. So I came at it through that route. Actually, I went to university to study history. The entire department was on sabbatical, so I ended up doing more and more economics courses. And initially, I found it quite easy. That changed as I got into graduate school. But it just continues to provide, for me, a really interesting way to think about the world. And as you say, I started out actually at the International Monetary Fund for 7 years as something of a financial crisis ambulance chaser. I ended up in a small team that looked at international capital markets, and it was at a time that was very volatile for financial markets globally. You had a Mexican crisis in 1994, you had the ERM speculative attack in 1993, Russian default. So there was a lot going on, and we just spent 7 wonderful years just sort of trying to understand financial crises. And advise the IMF on how to, if you can't predict them, how do you respond to them? And then, of course, in 1997, there was a big crisis in Asia. And so I had the opportunity to go to Hong Kong with Deutsche Bank and spent 25 years watching this remarkable transformation of the region that now accounts for almost half of world GDP.
Can you tell me a bit more about that crisis? What happened? I'm not familiar.
Sure. So in the early 1990s, what you had was you had this thing that I call the Asian economic development model, which in some respects is a replication of how Japan grew after the Second World War. And it's a very export-oriented development model. And that's quite different from, at the time, the way other emerging regions in Latin America and Africa and in Central Europe behaved. They were much more focused on trying to substitute, create domestic production to avoid importing goods. In places like Korea and Taiwan, you had explicit programs from the governments to encourage people to invest in activities that were targeted at the foreign consumer. And that sort of rippled through the region. So you had this surge of investment from abroad into the region to create the capacity to produce goods for Americans and Europeans, essentially. But with that investment initially came large current account deficits. And governments thought at the time that having a fixed exchange rate would provide enough certainty to foreign investors to attract that investment. But those two things came into conflict in the mid-90s. You had accumulating current account deficits, running down foreign exchange reserves to try to maintain stable currencies. And one by one, from the middle of 1997, those fixed exchange rates were broken. And what we had discovered in literally the weeks leading up to that was that behind the scenes, and for lack of data, really only anecdotally, everybody in these countries had built up enormous foreign currency liabilities on the assumption that the exchange rates would stay fixed. And so when the exchange rate was devalued, suddenly everybody's underwater on their foreign borrowing. And so you had a wave of banking crises through Indonesia, Malaysia, the Philippines, Thailand, Korea, Taiwan, and the other countries were affected badly as well. You had a massive recession because that fixed contract essentially was broken, and people didn't understand fully the consequences of doing that until it was too late. And so I spent the first 18 months in Hong Kong telling people how terrible it was going to get because the banking system has been destroyed, and until you recapitalize the banks, you're not going to be able to intermediate domestic capital. And that's essentially what happened. It was a horrible recession. But what we also learned was when you devalue a currency 40 or 50% against the dollar, suddenly you become an even more competitive exporter. So I think everybody is surprised, by 1999, these economies were booming again.
Yeah.
So it was a really interesting time. And then you got China coming in 2001, who said, that looks like a great development strategy, but we're going to keep the capital account closed so we don't build up those same foreign currency liabilities. And that's the story of the 2000s. China learning how to export, but not letting people build up those foreign debts.
Fascinating. To come back to your first point on starting out, I can kind of relate. As an educator myself, I also like telling stories and writing and educating people. I suppose that's one of the reasons you started the Substack, Temple Street Advisors, I think it's called. What was the real motivation starting it all?
Yeah. So as head of research and chief economist, there are broadly two parts of the job. One is providing content, talking to investors, writing about what's going on, educating people in a very real sense. Most of my conversations with investors were around some way to try to explain to them what was happening and what I thought would happen in the future, obviously more usefully. The second part of the job is administering what had become at one point, 200 plus analysts across 18 countries. And that's an incredibly complex problem. So what I hope to achieve with Temple Street Advisors and the Substack note that I call the Asia Economist, because I've been an Asia economist for now more than 30 years, is the fun part of the job, the creating the content, the engaging with people, trying to understand for myself what's going on, and explain to people what's going on with a broader perspective than I noticed was available both on Substack or Twitter or elsewhere. There's a lot of people writing about China, few people writing about Japan and India, not many people writing about the rest of Asia. So I'm trying to recreate the fun part of my job. And since it's a company that consists of just me, I don't have any of the admin that went along with being a head of research.
Does this give you the feeling of more freedom to where you can just talk about what you want to talk about, or?
Absolutely.
Was that different when you were still working for the bank?
Absolutely, both in terms of substance and style. For very good reasons, there are actually a lot of constraints on what you can say and how you can say it if you're working for a bank. And it's not that people are trying to be dishonest. It's just that the regulators and the banks expect you to be even, sort of level-headed, even, moderate, fact-based. Your opinion doesn't matter. You're trying to explain to people where the facts are leading you, and that's absolutely appropriate for when I was working for a bank. When I'm just writing for myself, really, and the 1,500 odd people now that read my notes, I have the flexibility to be a little bit more opinionated than I could get away with working for a bank. And also, I don't have people telling me, it'd really be helpful if you could write about X. I write about what I think is interesting. The fact, however, that it's just me does mean that, there are always going to be far more things that I want to write about and talk about than I'm able to, to do based on the limited number of hours in a day. And that, to be honest, that's a balance I haven't quite gotten right. The vehicle that I came out with is a note called Talking Points, which sort of provides people on Monday morning, first thing in their email box, a summary, my view of what's happened over the last week and what they should look out for over the next week or two, trying to put the world into perspective. It's not really a note that provides much scope to go deeply into things, and I'm now trying to sort of figure out how to do more of that. I have done some along the way, some little bit more thinking pieces rather than sort of quick reaction. But that's the downside of just being me.
Yeah, it's the reason we teamed up, because doing it alone is difficult, because your most precious resource is time, but it's also the most scarce resource. You only have 24 hours, and you gotta sleep, you gotta eat, you have a family, so there's the limited time.
Exactly.
I think we can both agree that the world is very dynamic.
Yeah.
Before we started recording, we briefly talked about Trump and what's happening and your thoughts on it. So there is more than enough stuff going on in the Western world.
Mm-hmm.
However, you decided to focus on Asia mostly for most of your career. What drew you to this part of the world?
It is to me, it's just simply the most interesting part of the world. As an economist, I show up in Hong Kong and I am responsible for a country like Japan, a very wealthy, aging, slow growth country, but a very complex, and particularly from an outside perspective, sometimes difficult to understand country. And then you've got these massive emerging market economies in China and India, and then lots of countries in between of different sizes, some very focused on producing commodity goods for export, some very focused on producing electronics goods. So it was that diversity that really attracted me to take the job to move to Hong Kong, the opportunity to think about, it is the fastest growing part of the world. It's going to dominate the global economy. And there is the full range of kinds of challenges and interesting questions that you would want to think about as an economist when you've got one of the richest countries in the world and some of the poorest countries in the world.
Do you have some examples of countries you used to follow a lot or follow right now besides China? I think that's the most obvious one.
So actually my first engagement with Asia was in Japan. And again, it was a banking crisis. Very early 1990s, I showed up at the IMF in 1990. By 1991, I was writing memos to the board about whether we could believe what the regulators were saying about non-performing loans in the Japanese banking system, and whether we should be worried about a financial crisis. And it was that kind of lens of, the way of thinking about economies through the health of the banking system that then made 1997 such a great time to move to Asia for reasons I explained earlier. But I think, and this, as I was thinking about setting up Temple Street Advisors, as I said, I look around what you can get in North America or Europe in terms of intelligence on what's going on in Asia, and outside China, there's very little. But there are very interesting things going on in the ASEAN countries, for example. And for them, real challenges, because they have really developed, as I said, on the basis of this sort of Asian development model, which is you allow foreign companies to come and use your land, labor, and capital to produce goods that feed into a Chinese production process that makes mobile phones for Americans or computers or what have you. It's very electronics focused manufacturing sectors where they're not really producing the final goods. So you're really dependent on fitting. What you're trying to do is fit into a supply chain that runs up and down the Asia region. And what Donald Trump has been saying for now 7 or 8 years, and people really haven't wanted to listen, is that in his view, the United States should no longer accept that. If you want to trade with the United States, you can't be doing that as part of a Chinese-owned or Chinese-dominated supply chain. So if you're in Thailand or Malaysia or Vietnam, which is really at the forefront of this, given the surge of Chinese investment into Vietnam in the last few years, you bet on that strategy of allowing Asian, Chinese, American companies to make hard drives or screens or cases or keyboards or what have you, that ultimately you're going to end up in the United States and Europe. And the US president just told you that that's not going to happen anymore. If you're a Vietnamese company and you're cooperating with a Chinese company to make things for Americans, you're going to face the Chinese tariff, if not a higher tariff. And I think still to this day, people in ASEAN haven't really woken up to that, that their whole development strategy for the last 60 years potentially is completely upended. Trump will find a way to separate the United States from China, particularly in the electronic supply chain, and he will not allow investors just to move production to Vietnam, Thailand, Malaysia, and continue on business as usual. And that's a story that I think even within Asia is not commonly told, and certainly in the rest of the world, people, I think most non-economists and probably even many economists still have a very simple view of what we mean when we're talking about trade. When you go to university and you learn about international trade, you're talking about Portugal sells wine to England and imports wool. That's not the world. Almost every country that we care about exports predominantly intermediate products that go into somebody else's production process that may go many times across borders before it's a final product that somebody might actually want to buy in a shop.
Do you mean like the resources, or like, does that mean when you say intermediate, like the steps in between?
So, for example, when I showed up in Hong Kong in 1997, virtually all of the hard drives that went into computers around the world were made in Thailand. So they were extremely efficient at making a product that 99% of consumers never bought. They bought it as part of a computer. Very few people were building their own computers and were in the market to buy just the hard drive. Philippines is an enormous business, taking computer chips that Intel would make, plugging them into a machine to make sure they work, and then exporting them back to where Intel wanted to send them to. Nobody's buying that chip except another company to put into a phone or a computer. So you are completely dependent on your customer, which is another company, not a consumer. You're dependent on that customer being able to sell to the consumer in the United States and in Europe. And that worked beautifully from the 1970s and 80s for that part of the world until, I would argue, 2018, when Donald Trump said, we've got to stop this. So when they talk about supply chain security in the United States, it's basically shorthand for saying we don't want China anywhere near a production process that ends up with a phone or a computer or any part of the ICT infrastructure in the United States that has anything Chinese in it. So if you're sitting in Thailand and you're exporting something to China or importing something from China and it fits together with the product, the widget that you make, and you send it to somebody else, and 7 steps down the road there's a phone or a computer or something, a microphone, and that gets sold to a consumer at Best Buy in the United States. That Trump wants to end that. He wants all of that manufacturing to move back to the United States, or at least move to a country where he is assured that there is no Chinese supplier feeding into it. And that requires potentially ripping apart all of these supply chains in Asia and redesigning them.
Yeah, it's interesting that you say this, because I've been thinking about this recently as well, where especially with all the things that Trump is saying, and so I was actually thinking about the supply chain as well. And so you mean, for example, let's take ASML. They'll need precious metals from Africa. They need special lenses from Germany and the United States. Then the machine is being made in the Netherlands. Then it gets sold to TSMC in Taiwan, where they sell the chips to all around the world. And yeah, it's very complex if you think about it. And you need friends and business partners to help each other, and you need to benefit from each other's strengths. And I think what Trump is doing is going to hurt them in the long run.
I think it will, but this is, I think, the way I understand where Trump is coming from.
Okay.
And let's start with something that is most easiest to understand. So the United States Defense Department has this massive procurement budget, And they realized 15, 20 years ago that an awful lot of that had computer chips that came from Asia or other components, or maybe the entire product is coming from Asia. And then they start getting worried. Well, if there's a Chinese supplier somewhere in that process, maybe they're not making, maybe it's not a Chinese semiconductor in this bomb or whatever, or device. But if somewhere along the way, some Chinese agent could sit next to somebody in a workbench and upload some code where all of a sudden my equipment's not going to work, or they're feeding information back to China that I don't want them to know. And I don't really know, I don't understand how I'm going to be able to search for this.
I see.
It's easier just to say no Chinese companies can get anywhere near the Defense Department supply chain. Well, the Defense Department isn't going to replicate TSMC in Texas all by itself. So you then say, okay, well, if we only want communications devices for the U.S. military and other military equipment, we only want those to be made in the United States. We have to sort of extend that to for all Americans to get an industry that would be viable. Otherwise, the Defense Department budget blows up even more. So I think that's what happened. But starting in the late, first term under President Obama, Americans realized that they had a genuine security risk, and that the way to solve that genuine security risk was to broaden your definition of security and say, all right, Americans in general should not be importing technology where there's a risk that a Chinese company like Huawei, which became the poster child for this concern, a company like Huawei might somehow have interfered with the technology, uploaded some software, or created a backdoor so they can spy on us or change how the equipment functions. That, I think, is where Trump is coming from. And you can see that, yeah, that sounds pretty reasonable. So the question for Trump is, if I want to move all of that production back to the United States, I want to have as big a market for that as I can to make it as profitable for TSMC and other companies to move production to the US. If I end up with simply the US market and the whole rest of the world continues to trade amongst itself as normal as before, I'm cutting myself off from the rest of the world, and I'm going to end up with a much higher cost of capital, because it's going to be much more. We know it's going to be 30 or 40% more expensive to make an iPhone in the United States completely from start to finish than it's currently possible in Asia. So for Trump, the more you can get countries to come with you, exclude China from your supply chain, so therefore you're safe to be part of an American supply chain. If you can get the whole world ex China, that might work. If it ends up with the whole world ex the United States, then I think this blows up in the US. You end up with an isolated US where there's a technology stack that makes sense in the United States, but it's very expensive, that nobody else wants because it's very expensive. And the whole rest of the world continues to trade and innovate amongst each other, and the US is isolated. And that, to me, is the direction we're going today, because by starting his trade war with China, by actually imposing tariffs on Canada, Mexico, Japan, and the EU, he has alienated any country that might actually be willing to discuss your security concerns. And maybe we have similar concerns. As in his first term, he was making some progress in convincing European countries that maybe there was some logic to separating your technology stack from a Chinese supply chain. He has completely blown, as you say, the trust with any other country. So the way we're heading now is we're going to end up with the United States isolated, and the whole rest of the world is going to sign up for free trade amongst each other. So you have in Asia, you have this TTP, sort of the Trans-Pacific Partnership that became the TPP ex the United States. You now have the UK has joined, other European countries, Canada said they want to join, China wants to join. You could end up with essentially the rest of the world saying, we still believe in free trade and free investment, and we'll just, we'll park the US over there. Now that's painful. The US is the biggest economy in the world, But if that's where you want to go, fine, but you can't take us with you. So in very crude terms, again, I mean, the message to Vietnam and other Asian countries is, if you want to trade with the United States, you can't trade with China. And that's not something that I think they will sign up for. China is more important to these economies as a source of imports and as a destination for exports than the US is. So if you force them to choose, it's not obvious they're going to choose the US. So I think we're going down the path where the US will remove itself from the rest of the world. They will end up with a technology stack that works for them, but it will be hugely expensive compared to the rest of the world.
Fascinating to think about, huh? Sorry for dragging you into all the Trump talk.
No. It's sadly, I mean, since January 20th, that has been the beginning of every conversation. You know, there are certain things you have to establish in your mind about what's going on in the world, and that is one of them. So, for example, I mean, we're talking on the 29th of May. Barely 12 hours ago, the U.S. Court of International Trade said that your tariffs are illegal, the reciprocal tariffs. Now, so you have to make up your mind this morning if you're an investor. What does that mean? Is Trump going to back down? Or is he going to find some other way to replicate those tariffs? And my assumption is he'll use Section 122 of the 1974 Trade Act, and he will find another way to temporarily put in place all of these tariffs. And then he'll try to find some way over the next 6 months to make that permanent.
So to follow up on what you just said, do you think staying on the ball and watching the news, seeing what is happening around the world, do you think that is actually important for investors that are focused on the next 10, 20, even maybe 30, 40 years for their investing life? Or do you think it's more useful for, I don't know, hedge funds, traders, banks?
Even I would submit that even for somebody who's sitting on a trading desk, you need to think about risks to your portfolio that are, as you say, very short term. What's going to happen over the next 48 hours, 6 weeks? And what is my view of the world 2 years down the road? What is my view of the world 20 years down the road? And are the developments that are the trends that I'm seeing in the very short term, are they taking me back towards where I think we're going to be in 2 years or further away? And that's how I think investors, good investors, sort of think, right? There's short-term volatility. Am I going to, sell a rally in equities because I'm fundamentally bearish, or am I going to ride that because actually I'm fundamentally bullish? That's, I think, the way investors think, and I've got a medium-term view of how I think economies and markets are going to behave, and I can't let the short-term trend knock me off that medium-term view, and unless everything suddenly starts to line up to tell me my medium-term view is wrong. Very few people on a trading desk are going to have a 20-year view, but when you get into the C-suite of a corporation, their weight is, all right, we've got short-term stuff, I've got a treasury department, their job is to manage our risks in the short term, make sure that we don't get blown out by an exchange rate or interest rate spike. My role as a manager is to have a 2 or 3 year view for strategic planning purposes. But when we're thinking about making a big capital investment, that's where my 10, 20, 30 year view comes into play. And I would submit it's a similar thought process. We may see trends over the next year that say, well, consumption in China looks really flat, but my 20-year view is still bullish. My 20-year view on India is even more bullish. So, what's our exposure over the next 6-8 weeks? What are our plans? What are our forecasts telling us about the company's profitability over the next couple of years? But thinking further ahead, that next big investment is going to be driven by my long-term view, not my short-term view. So I think what I found talking to different types of clients at the bank was that everybody essentially the smart people had essentially that same kind of thought process. You just shifted the time frame. A hedge fund can have a half-hour view. stretching out to maybe a 6-month view. Um, Somebody who's running a long-only pension fund portfolio will probably be more interested in the 12 to 24-month view. And then corporates genuinely, I mean, I had conversations with big European companies where you are asking the 30 or 40-year view of India versus China. Um, and that's part of what makes investing interesting, right? Is that there's always going to be a different perspective, both in terms of time and what matters for you.
Definitely, yeah. So let's shift focus and talk about Asia,
Yeah.
especially from a macro and investing standpoint. Now, for a lot of investors, especially those based in the United States or Europe, Asia can feel like this massive investing space. It can be exciting, but can also be quite intimidating. It's home to some of the fastest growing economies, but the culture is a lot different and it has a lot of complexity.
Mm-hmm.
So, what makes Asia such a compelling place for investors, do you think?
I think for investors, what makes Asia interesting is precisely that diversity that I talked about before. Potentially there are real opportunities for diversification of your risks. We've got a couple of markets, Indonesia and Thailand lately have been negatively correlated with US equities. Now they're not big markets, but if you're running a portfolio, a smallish portfolio, that may be an opportunity to get some diversification. But as I said, you've got rich, advanced economies. You've got very poor countries that are inherently growing more quickly. What makes it challenging for investors, though, is the lack of information. If you're a European or American investor, you can be 99% sure that you are receiving information from the companies you invest in at the same time as everybody else. And when that doesn't happen, the regulator finds out there's hell to pay for the companies that leak information selectively. Unfortunately, in Asia, it is still the case that if you're not there on the ground, you really can't assume that you're going to find out what's going on at the same time as everybody else. It hopefully doesn't happen anymore, but I can tell you that there were senior policymakers in a number of economies in Asia who had, they communicated to the market through a private WhatsApp chat room. So they had a dozen journalists or investors on their phone, and they wanted to get word out to the market about how they were thinking about maybe changing policy. They would just WhatsApp everybody. It was very efficient for them, but completely excludes everybody that's not in their phone's contact list. And that, I think, is what makes investing in Asia really challenging, is that you sort of have to assume that for an awful lot of the markets, the companies, central bank decisions, Ministry of Finance decisions, that you're going to be the last to find out. So you need to invest, I think, on the basis that I'm protected. I have a view on what I think they are probably going to do, but I understand that every once in a while they're going to do something that I didn't anticipate. And then I find out that the locals sort of all knew that was going to happen, and that's life investing in emerging markets.
So, how does that apply to you? Since you like to focus on Asia, do you feel like you have an edge there? Do you go to Asia, or do you feel like you're kind of always a step behind?
Even when I lived in Hong Kong and I traveled 2 or 3 days a week for 25 years, I always felt, I'm not a local in any of those countries. I had people that worked for me. We had traders in all of these markets, and I tried to stay as plugged in as I could. And that was an important part of working for a bank, was having that network of people where if you really wanted to know what the central bank was thinking, I could call up the senior trader and they might tell me. And once in a while I would say, well, that's very different from what I would be thinking if I were in their shoes. The way I handle that, to be honest, is to focus on a time frame that is not so short term that it's dependent on me being on the contacts list of the central bank governor. So when we get down to a week or two before, or a week, say, before a central bank meeting, or some time frame like that, where I think policymakers have probably made up their minds, they're not going to give me any heads up. but they might be giving people locally nudge, nudge, wink, wink. So if I just focus on, I'll tell you the way I would describe it to our clients was, I will tell you what in 12 months' time everybody else will be telling you about the next year in each of these countries. I mean, I will tell you, I'll give you my view of what's going to happen next week, but you're probably, to be honest, better off talking to our head trader, because he knows the governor or the minister of finance, or he knows the treasurer at a company that's about to make a big announcement. So my focus was generally, where are we in the business cycle? In 6 to 9 months' time, everybody's all of a sudden going to start getting bullish because we're currently in a downturn and everybody's bearish. But I think in a year's time, things are going to look a lot better. So I would focus on that for most investors, a sort of medium to longer term. The economy's gone into recession now. Everybody's telling you it's terrible. You're on the phone every day to the central bank governor. Fine, I get that, and I can tell you how I would be behaving if I were them, and I go and talk to the central bank as often as I can to try to check my biases with them. But I would always start my presentations with, this is the way the world is going to look in 12 months. In 12 months, growth is going to be rising. Central banks are going to be tightening. Ministries of finance are going to be pulling back on that stimulus. Profits are going to be rising. And that's how I would get around the fact that if the central bank governor wanted to signal that the market was positioned the wrong way, and he didn't want to blow up the market the next week when he had to raise interest rates, so he wanted to sneak that out to a few people and get people changing their positions, and that happened, then the fact that I'm not getting that message means that I leave that to the locals. And I will just, as I said, I focus on something a little bit longer term that isn't dependent on anybody's sort of short-term decision making.
So you lived in Hong Kong, you said, I think?
Yeah, I lived in Hong Kong for 25 years. And if you live in Hong Kong and you work for something other than just a very Hong Kong-focused company, that means you spend, a third of your life on an airplane.
That's pretty ridiculous if you think about it.
It was a wonderful job.
So you lived there with your family?
Yes.
So I think many of our readers and listeners would love to know more on that, perhaps on differences. I mean, differences compared to Western markets. How do you think Asian markets differ economically and culturally from Western markets? Is an Asian consumer really that different from a Western consumer?
No, I don't think so. And in fact, for most of the time I was there, you would say that, for example, Western brands were the premium brands. It did get to the point, which was quite, ridiculous. You could go to any sort of capital city in Asia, except, I would say, in India, and you'd find a Starbucks on the corner, you'd find a Gap around the corner. I mean, so you had American brands everywhere. In the manufacturing space, European products were, there's no question. If you needed to buy machine tools, you bought German machine tools. That changed, that sort of mentality changed, I think, by about sort of 2014, 15. Really, what the Americans like to call the global financial crisis, I would say is maybe an Atlantic financial crisis in 2007 to 2009. That really changed attitudes in Asia. And one thing the consumers saw coming out of that was, all of a sudden, Asian companies that had been making shoes or anything, mobile phones or whatever, for American companies under their brands, started to sell product under their own brands. And it created a real awareness that there were Asian brands that were in many respects better than, an iPhone. And that, so for the first 15 years I was in Asia, the height of luxury was to buy a Western brand. After 2009, that progressively changed. There was a growing sense in Asia on the part of consumers that we get better products. If you look at apps, sort of mobile gaming, it's an Asian invention. You look at what Elon Musk says he would like to do with X, putting finance into it and creating, using X as an ecosystem for you to live your life on, as opposed to simply a source of information and maybe messaging. What he's really saying is, I want it to be like WeChat and Alipay. I mean, you go to China and you spent your entire life is intermediated through your phone. Everything you want to do is on your phone. Finance, movie tickets, holidays, restaurants, everything is on your phone. It's unbelievable from an American, European perspective. Unless you've seen it, you just can't imagine. And that is pervasive now in Asia. So what it has done in the last few years, it's created an expectation in Asia that, when you roll out a product to a consumer, it's got to be a very sophisticated product. I find when Asian people and people from Hong Kong or Philippines or whatever come to North America, they're surprised at how backward technologically this part of the world, and Europe, I would submit even more so, is compared to what they get. But they're fundamentally the same people. They just want to get the cheapest product, the best product, for the best price. What is interesting about how markets behave in Asia, and this I think it's already to some extent changing, is every morning meeting in every bank and asset manager in Asia starts with the S&P 500 and the US Treasury yield. What happened overnight? And it's not just because that's 12 hours where we were otherwise occupied or asleep. It's because equity markets in Asia through the 1990s and early 2000s were simply high beta representations of the S&P. If the S&P went up 20 basis points yesterday, Asia would be up 2.4%. And every market would do the same. We simply went up and down with the S&P. Why? Because exports were largely driven ultimately by growth and demand in the United States. And so you had profit cycles that were the same as the American profit cycle. Equity markets essentially priced that in. But because the export sector was so dominant in these economies, if exports suddenly are expected to get weaker, you really sell everything. So we had a beta greater than one. We were, as I say, a high beta representation of the US. If you look at fixed income markets, as capital controls were taken off, bond yields in Asia became more and more and more positively correlated with the US Treasury. So when you look at Asia from the perspective of an investor, if you really want to get diversification and tap into real Asian growth, you have to understand that the broad market is going to do what the US market does. Now, over time, and given what we were saying earlier about how Trump is potentially separating the US from the rest of the world, over time that will change. And today, correlations are generally positive, but the beta is no longer greater than one. But that's a sort of, I think, from an Asian perspective, the problem is our capital markets behave like the US capital market, but the US is over time becoming a less and less important driver of our economies. And how do we get away from that? So, as I said earlier, if you look today, in Thailand and Indonesia, the equity markets over the last 5-7 years have really decoupled from the S&P. Other markets still tend to move up and down. And you look at fixed income markets, with the exception of the high yielders in Asia, essentially we have an Asian bond market that replicates the US bond market. So we have this diversity of economies, but when you look at the region from the capital markets perspective, it looks very familiar if you're an American.
When I say the United States, we all agree that's a country. And we talk about the Canadian stock market. We all agree that's a country. But when we talk to investors, and they usually talk about Asia or Europe as they were both one country. Do you believe that investing in Asia is generally quite similar? Or do you believe that each country should be understood independently before you can invest there?
There are always going to be country-specific factors that will impinge on your investments. So I think, if you're constructing a portfolio for Asia, I would I would look at it from the perspective of, if I want to be overweight the Asian consumer, I've got possibilities in China, Japan, Indonesia in particular. I mean, it's the most populous country in Asia, other than China and India. 300, well, they don't even know how many people there are. 100, So there are. I think it doesn't make a lot of sense to say I'm going to be overweight Indonesia versus Malaysia, or Malaysia versus Thailand, because the business cycles for these economies are so similar. But you can get access to really interesting consumer plays in China, India, and Indonesia. Whereas, to be honest, from a outside-in perspective, if you're looking at the consumer in Singapore, that's interesting, but there's not many of them. So there are ways to construct portfolios across the region that, to me, make more sense when you look at sectorally rather than I need to be overweight this country, particularly when you have equity markets that may be dominated by a particular sector.
I think what I mean, I feel pretty comfortable investing in South Korea. I feel pretty good investing in India, maybe even Taiwan. But I don't really feel comfortable investing in China. So I think my question is more that, as an investor, should you understand how investor friendly it is in a way? And because my question was about how do you trust the country? Do you trust the government of the country you invest in, is kind of what I'm saying.
You absolutely have to, anytime you're investing outside your country. And sadly, I guess that's a question we now have to start asking ourselves about the US. So you talk about China, absolutely. I mean, it was, not so long ago, it was fashionable to say that China was uninvestable because people thought that the government would not allow private investors, domestic or foreign, to make money in the stock market or to make money as an investor in real physical capital. So you definitely need to have that comfort level. Now, China adds an additional complexity in that there are generally, for a foreign investor, you're going to invest in China through Hong Kong. So you have the North-South Stock Connect and Bond Connect and Wealth Management Connect, and because China likes to believe it has capital controls, or it does have a capital controls, except in some respects they're not really effective. But what they like to do is they set up routes for foreign investors in and out of the country where they have either a quota or they certainly have visibility, and they can, if they want to, close the taps or open the taps. They're not alone in trying to do that, but they're probably more effective than most other governments. So yeah, if you're going to invest in an A share in China, which is the onshore equity market, you need to be comfortable that the government's not going to suddenly close the door to capital outflows. And that uninvestable thesis a few years ago came about because the currency came under some pressure, and for a few weeks it was very difficult to get your money out of China. In fact, for a few months it was very difficult to get your money out of China. So you invest in emerging markets, particularly a country like China. You invest with an understanding that it may turn out that investment gets trapped. Maybe not permanently, but you may find that you want to sell and you can't get your money out, and that situation may last days, weeks, months, years. And China's not alone in that, but generally other countries in Asia who have imposed sort of, if you will, ex post capital controls, learned that really was not helpful and have avoided it. So, I think of Malaysia and the Philippines at different times, and while I was in Asia, had engaged in that, or at least led people to suspect that if the market sold off, they might find that they couldn't get their money out. And they, by the mid-2000s, they were routinely pushing back when anybody suggested that they might reintroduce capital controls. Because they learned the lesson. If you, as Malaysia did, if you close the door and don't allow investors to leave, you're not getting any money in, And then when you do eventually open the door and let people out, they leave and they don't come back in a hurry. So you may have bought yourself some stability in the FX market in the very near term, but at a real cost to your credibility. It's been a long time since China has, well, a long time. I'm saying, many months, probably more than a couple of years since China has really interfered with people trying to get the money out of the country. It's not as straightforward as it is in other countries, but generally speaking, if you sell an asset onshore, you can make your application to take the money out and you can get your money out. But if the currency would suddenly depreciate, a few percent, you may find it takes an extra day or two or three.
During your time in Hong Kong and Asia, I can imagine you travel to other places as well inside Asia.
Mm-hmm.
What were some of the things you were most surprised by at the time? Is it because I haven't been to Asia yet, but from the many different people I talked to and from several guests we've had, I hear that, for example, the technological innovation there is much more advanced than many of us assume. So I'm just curious on your time there, or perhaps even from what you know now, what are some of the things you were most surprised by?
I would say that when I was first there, so I started traveling to that part of the world when I was at the IMF. So 1992, I think, 3 was my first trip. And even then, this was slightly early days into sort of communications technology, computers and mobile phones. They were emerging from the region, and Asia was already dominant in that space. But by and large, Asia was producing these goods for export and not consuming them themselves. And there were folks at the World Bank and elsewhere who went deeply down a rabbit hole on what they called the complexity of Asian manufacturing. And they were saying, look, they're producing goods that are far too complex for the relatively modest incomes of Asian consumers. And my response at the time, and this is, we're going back 25, 30 years, was yes, because they're not making for Asian consumers. They're making for Americans and Europeans. And I remember that really struck me was driving back out to the airport in Taiwan. And of course, TSMC, UMC, it's if you will, Taiwan is, as we say, the Saudi Arabia for technology. And you drive along a toll road out to the airport, and the taxi driver is getting a piece of paper from one toll booth and then handing over a piece of paper with a banknote to the next toll booth and getting another piece of paper. And I thought, this is crazy. I mean, as I said, it's this is the center of the ICT revolution, and you're still collecting tolls with pieces of paper on a 6-lane highway, and that really brought home this reality that Asia was producing the most technologically advanced products in the world, but not consuming them. And now, as I said earlier, it's completely reversed. Asian consumers have access to technology that folks in the West could only dream of or fear. To be honest, I mean, if I show somebody my the Tencent app on my Hong Kong phone, they're slightly horrified that that they know all that about you. And the answer is yeah. I mean, do I trust them? Not necessarily, but it is so convenient that I'm willing to recognize that I give up a considerable amount of privacy for the luxury of basically managing my life on my phone. And I'm convinced that this will come to the rest of the world because it is so efficient and convenient, and people's I think will respond positively as it becomes more available. But as I said, for an average mainland Chinese person coming to North America must be horrified at how backward technology is in this part of the world.
Yeah, that's funny to think about. China is such a weird country. It's a huge success story. I mean, they went from a country that started as basically a third world country to one of the leaders in today's world, perhaps even the leader if the United States continues on its path.
Mm-hmm.
But at the same time, it's it's a combination of a autocratic, socialistic, capitalistic country. What's your view on investing in China long term? Do you think it will get better, or do you think it will get worse for investors?
I'm still very positive on China in the sort of medium to long term. I think I guess there's broadly two things I would say about China. That one that sort of speaks to maybe an error in how people think about China. It's a little bit less prevalent today, but generally there's a perspective that says China is so different that I'm never going to understand it, and therefore sort of uninvestable. When you look at how the economy functions, how the financial system functions, how the capital markets function, it's very similar to the rest of the world. I mean, the Chinese growth miracle was no mystery. You take a third of your population that lives in cities, and you grant them their apartments, and then allow them to buy and sell apartments. You create property rights, and then you create a market for those property rights. It was probably the single biggest wealth transfer the world has ever seen. It's no surprise that the economy is going to take off. And then you go to the 2/3 of the population that lives in the countryside and say, we'll do the same thing for the asset that matters most to you, which is the land. We'll give you more of the property rights to the yield from the land. You can start selling your product in, however you want to in the cities or whatever, create new markets. You want to set up shop and, light manufacturing industry, go ahead. And so it from an economics perspective, it's very understandable how China has evolved. From time to time, politics has impinged on that, which happens in advanced economies too. From time to time, politics impinges on the US, as we're seeing today, in Europe. 10, 12 years ago, you had a sovereign debt crisis in Europe. That certainly impinged on how investors looked at investment prospects within the EU. So that's the first thing I would say, is that when somebody says China is so alien and so different that it's not, I can't invest in it, 90% of what goes on in China is entirely rational economically. What has been a problem for the last 10 years is that you have a central government in China that is no longer deliberately trying to stimulate faster growth. Xi Jinping's interests are not perfectly aligned with investors' interests the way they were under his predecessors. He took office at a time when the party was in disrepute, corruption was rampant, it was not functioning properly, and there was real concern that the party's legitimacy and its ability to govern China was at risk. And he is still more motivated by those considerations than trying to get GDP growth up. When the economy gets a knock and things look like they're getting worse, the system, the government, the central bank, the regulators do respond, but they're responding in a way to sort of put a floor on growth. So investors have for years been waiting for this magical big fiscal stimulus that's going to bail them out. It's not going to happen. In the same way that the central bank, a 10 basis point rate cut a few weeks ago, 8 months after the previous 20 basis point rate cut, they are not trying to stimulate faster growth in China. They're just trying to keep things stable while the real energy of the government goes into encouraging investments in new technologies, encouraging the adoption of new technologies, trying to maintain markets for exports. All the stuff that governments in the rest of the world say they want to do, China is doing, and they're doing more effectively. So the reason I'm positive on China in the medium and long run is that eventually those investments in new technologies will pay off. And you can find anecdotes today that says it's already happening. There are many examples today where these investments are starting to really deliver profitability and growth. But for an economy that big, it's going to take some more years. And that is, the respects in which China is different is really twofold. One is the government now no longer worries about a threat to its ability to govern the country. So they can take a longer term perspective, be less focused on goosing growth in the short term, more focused on the medium term productivity growth story, and that's delivering. And I'm convinced that over the next few years and for the following couple of decades, you're going to see growth in China pick up relative to the current view that it slows down inexorably towards 2% in 20 years. I think the economy is going to surprise to the upside, despite a shrinking workforce. Growth will surprise to the upside as these technological innovations, new sources of energy, new materials, new equipment, new technologies deliver growth in China in a way that the rest of the world wishes they could get for themselves, but governments keep getting diverted to shorter term considerations just for the purpose of staying in office. So I am positive on China in the medium and long term for that reason, that they have the luxury of investing in these technologies that every country in the world says they want to, but China is more than anybody else. And I think that will pay off. If you're a technological optimist, the way you want to express that is China more than just about anywhere else. The other part of the Asia story that I'm bullish on still is India, for essentially a very similar reason. India is the last big country in the world that has a positive demographic dividend, a working age population that is growing as a share of the population, and will continue so for probably another decade. They're making real progress in what they call process reform in India. I mean, the complaint about India was it just took forever for anything to happen. You wanted to buy some property, it could take years. If you had a commercial dispute, it could take decades to resolve. If you had to deal with the government, it would take ages for anything to happen. And then the government, when it tried to send transfers to poor households, a big chunk of that would get stolen. Now what you have is if you think about the digitalization of households around the world, this is an India and China story. So in India, you have these biometric ID cards that allow people to go and open bank accounts. In fact, you don't even need to go to the bank anymore. You just open the account on your phone. The government can then deliver services directly to you without a middleman there potentially taking their 10% off the top. They're improving processes within government, making courts more efficient, making government bureaucracies more efficient, trying to streamline investment approvals processes. All of these things that gradually, little by little, because it is India still, little by little make it a more investable place. It is the only country in the world that really properly could rival China as a manufacturing base, and you see that Apple has made that shift, and now they're getting beaten up by Donald Trump for doing what is perfectly rational. If Chinese labor is getting too expensive, I can move to India, where I've got this enormous labor pool, much cheaper, and I can replicate the miracle that I saw in China from the 1990s through the 2000s. You could potentially replicate that in India. Probably, to be honest, you're not going to get 2 decades of 10% GDP growth, but I'm very positive on India, because what happened in China is very understandable as an economic dynamic, and I can see the potential for that to play out in India.
So India and China are two countries to watch. Any others?
I think you want to be long both those countries on a medium to long term view. So you buy them, and you may get some knocks over the next 12, 18 months, but valuations look very cheap, particularly in China, where nobody's invested. But the medium long term for both those countries look very positive. I remain, and generally for the last 20 years have been, much more worried about the ASEAN region, because they are not, by and large, they don't own the technology. They've simply been a very supportive place for foreign companies to make things, and that there is either no longer the need for that, or if you're Donald Trump, you simply don't want to allow that. So ASEAN needs to reinvent itself, which is a challenge when you've got 30% of GDP coming from manufacturing, which is mostly intermediate goods rather than final goods. So you've got an enormous capital stock that needs essentially to be written off before you can get new investments in something that may make sense. If you have an industry that is sized for the world, you make all of the world's hard drives in Thailand, and all of a sudden that industry needs to go, you can't simply turn around and say, well, we'll just make them for Thais. Firstly, you're not making something that consumers buy. Secondly, you've been making hard drives for the world, not for the this much smaller entity we call Thailand. So that's the real challenge for the ASEAN region, is they have these enormous successful export industries that have captured economies of scale for the globe. You can't simply turn that around and say, well, now you're going to make stuff for Filipinos or Indonesians or Thais. You've got to, if that industry is going to leave and Trump gets his way and it goes to the United States, you're going to replace it with something that's much, much smaller, which means you're laying off millions of people, you're destroying investment capital before you can reinvest. And that's going to be a very painful process for ASEAN. Now, the way they are positively responding is to saying, look, we've got to become much more integrated. So ASEAN free trade, I mean, they finalized that, I think, in 2015. It's still a bit more aspirational than it should be. But the answer is, if we look at ASEAN as a combined economy, it starts to look a lot more, the economies of scale are a lot more impressive than if I'm just looking at Malaysia separately from Thailand, from Indonesia, from Philippines. So that's the future for ASEAN, is to really deliver on that promise to create a common market within these countries. You're still going to have manufacturing sectors that are too big because you're a few million people, not a few billion. Sorry, you're a billion people, but you can at least make some progress to limit the downsizing that's going to be required if Trump gets his way. What they're hoping, to be honest, is that Trump disappears and we go back to business as usual before.
So let me give you some pushback on what you just said. I don't like being a yes man, so sometimes I like to take the opposite stance.
Sure.
So, yes,
Good.
China specifically has grown immensely over the past few decades, but that hasn't really translated into profits for investors through the equity markets. I think a lot of global investors are wrestling with the underperformance of Asian markets, especially when you compare them to European or US markets over the past decade, say the S&P 500 or the NASDAQ. So GDP growth or a growing population doesn't necessarily mean a good stock market. I think most of that comes from the fact that the US used to be the most trustworthy and growing market, especially tech-wise. But that does lead me to my question. Well, the answer over the past decade was it's not worth investing in Asia. If you knew this 10 years ago, it was probably better to invest in the United States. So do you think it is worth investing in China and Asia today? Do you think this will be a better decade for Asian equities?
So you're right that over the last sort of 10 years or 10 or 12 years, Asia has, at the index level, underperformed. And there are a couple of things going on. One is we have what we call now, I guess, the Magnificent Seven in the United States. These large mega cap technology stocks that really nobody else has. I mean, China has lots of successful technology companies, but they haven't delivered, to be honest, the kind of returns to shareholders that Apple and Microsoft and Google and their peers in the US have. But also, they haven't been as big a part of the index. So, I mean, at this point, those 7 mega cap stocks are almost a quarter of the S&P. Almost a quarter of the S&P. So their counterparts in China haven't dominated the index to the same extent. So part of the Asian underperformance is US exceptionalism, as we have been calling it until maybe now. And for the same reason that Europe has hugely underperformed the S&P over the same time period. The the second part is, yeah, to some extent, if you're investing in China, you're doing that by buying Siemens. European companies that invested in China to become more profitable. I mean, if you're investing in an export-oriented activity in China, then by definition, I mean, you're not going to be buying a Chinese company for that. You're going to buy the BMWs and the BSFs and the Siemens and European companies that have taken advantage of that export platform in China. Apple, to a great extent, right? And then the genuinely Chinese part of this underperformance is really twofold. One, just in very recent years, you had another property cycle that has been more protracted than past cycles, and almost entirely deliberately. So when I said earlier that Xi Jinping isn't really concerned about goosing growth in the short term, he actually created this property downturn. I mean, in the middle of a pandemic, he decided to impose binding financial constraints on the biggest property developers in the country. At a time when they were struggling to sell property because people weren't allowed to leave their apartments, he suddenly said, well, you've got to clean up your balance sheets. So this, he created this. There are signs that the property market is beginning to bottom out. If you look at Tier 1 cities, as we call them in China, the top 10 cities account for about a quarter of the population, and property prices there have been creeping higher over the last sort of 7 to 9 months. So that's one factor. And then secondly, the counterpart to not being so focused on goosing growth in the short term is Xi Jinping has been more skeptical of the importance of supporting private enterprise. And that was because he saw private companies being so tied up with corrupt officials and corrupting officials that he needed to separate the party from the private sector. And when people in the private sector pushed back, he pushed back even harder. So created, I think, more than a perception, a reality that the private sector for a number of years really was in the doghouse, as we might say. He is now, I would say over the last 7 or 8 months, he's trying to provide more reassurance that he cares about the private sector, recognizes the value of private companies and entrepreneurs to the future for China, recognizes their contribution to productivity growth and technological advancement. If you're a private company in China, you will still be expected to support the government in ways that private companies in the rest of the world aren't required to. But I think that sense that private capital in China was running scared, I think that's beginning to change since late last year. So those two things, I think there's genuinely a Chinese aspect to underperformance. Xi Jinping took office 2012, and by 2013 you can see the Chinese market relative to the S&P was in decline, but there was an important US exceptionalism part to that as well. So where are we today? Then you think, well, what might change that underperformance? Well, are the Magnificent Seven going to continue to outperform to the same extent? Well, even Donald Trump's White House is continuing antitrust cases against some of those companies. The European governments and other governments are looking to make sure that they are paying their fair share of taxes, however you want to define that. Antitrust cases against some of these companies in a number of countries. So my bias would be that life for the Magnificent Seven over the next 10 years is going to be much less promising than it has been over the last 10 or 15 years. On the Chinese side, as I said, you can look at the property market. I would look at the property market and say things are certainly less bad, in some respects genuinely getting better. Don't expect the government to throw in a big fiscal or monetary stimulus. They're just waiting for the market to adjust, and it looks like it has enough in some parts of the country. And we wait for either Xi Jinping suddenly to get genuine religion on the private sector, or we have to wait for a replacement in due course. Hopefully we don't have to wait that long, but he's saying the right things. He's having his picture taken with the right people. The government is trying to communicate more positivity around private investments. We just have to wait and see that to happen. But as I said earlier, I mean, if I were to take a longer term view, barring some really sort of low probability disastrous kind of events, I would expect that the investment climate in China improves over the next decade. I would expect to see these technological advances that they are making at least as fast, if not in many respects faster than the US and Europe, to pay off. If only for investors, but probably also, I think, even you'll see a genuine, real economic return to these investments.
You answered my question before you even knew the question. I was going to ask you what would I was going to ask you what would need to change to bring capital back to China and make it more investable, so to say. I just checked the time, and I'm generally enjoying our conversation. It's been a good talk so far, and I'm learning a lot of new things as well and getting some new insights, which is why I love doing this. So, how about we?
Well, thank you.
We work towards an ending. I have like two more questions that just came up.
Sure.
For those who are interested by Asia, and I am one of them, and perhaps for those that don't really know where to start, what kind of advice would you give investors or people interested in Asia, or even people that are interested in Asia and want to understand the consumer, the markets, and find footing there? What kind of advice would you give them?
The biggest obstacle is information. Because for most investors, there are going to be a language barrier. Certainly for me, there's a language barrier. When you travel to every country in the region half a dozen times a year, I can be polite in lots of languages, but not conversant in many of them. So I think you need to find ways to try to get a local perspective on the news. And actually, Substack now has a number of really useful blogs. There's Fred Gao, I think it's called Inside China, China Banking News, the NPC Observer does a good job sort of keeping you informed and translating government documents. There's actually a Substack, Robert Wu has a Substack called China Translated. So you can get over the language barrier. Bill Bishop at Cynicism, also very useful.
Jeff Towson, I like him from the. I'll have to look up the name, but Jeff Towson is like this. He has this podcast on Asian technology companies, mostly China.
Right.
Very good as well. Yeah. If you haven't heard of him.
Yeah, I have. So the first thing I think you need is somebody who can do that translating for you, tell you what's going on, without relying, to be honest, on Wall Street Journal, New York Times, FT, or whatever, because they will come at it, particularly American news sources will come at it from a particular slant.
Yeah.
Second thing, if you're looking at individual countries in Asia, I do think you need access to analysts on those countries who are on the ground. So you may think you understand a certain technology, and you look at a company that's listed in China, so well, they do that, so I'm bullish on this, so I'll buy that. To be honest, the unpublished nuance about so many companies in Asia in terms of what's their political risk that people don't talk about, are they in or out with the government, and this is not just purely a China thing. So I do think before you start buying, putting a lot of money into stock in a particular company, you want to find an analyst who follows that company and has done for a few years at least, and at least be able to read their research reports, if not talk to them. Because almost invariably there's, if the stock looks like it's underperforming, there's probably a good reason for that. And it may be a reason that, you've got to talk to the analyst in person to find out. So that information barrier, I think, is the biggest barrier. Otherwise, I would say, look, you buy a China mutual fund and just sit on it for the next 10 years and it's going to outperform. If you want to do better than that, or you want to be more tactical, then you need to talk to somebody who talks to those companies before making that investments. And then outside China, there's, again, on Substack, Mekong Memo is a great way to keep informed about. For me, it's a great way to keep informed about what's going on in the ASEAN region in particular. So we're blessed on Substack with a lot of really good resources. Most of my reading, to be honest, given where I come from, I spend a lot of time reading academic papers because I have an idea about what's going on in some aspect of economic development or financial markets in these countries, and I want to read academic papers where people have actually put that to the test. So I spend a lot of time on different central bank and economics department websites looking for research. But in that, if for investors, what I would say is the Peterson Institute on China-US trade, the single best source there is, and the Rhodium Group for big picture China-US macro, particularly a lot of work they've done on One Belt, One Road and FDI flows between Europe, US, and China. They're outstanding.
I always like to end on the following question. If you had to give one piece of advice to, well, in our case, long-term investors, which is our audience, trying to make sense of Asia, but also looking to perhaps invest in Asia today, next year, whatever it may be in the future, what would your best piece of advice be? I think you kind of already told us that you need to get
move to Hong Kong.
Move to Hong Kong and follow the right sources. But anything you would like to add here?
Move to Hong Kong. No, if you want to invest in Asia, and that's going to be the biggest part of your job or your portfolio, move to Hong Kong or Singapore. But I would say Hong Kong it's a wonderful place, so convenient to everywhere in the region, and that's where all the analysts are.
And the food is pretty good, I've heard.
Food is outstanding.
Well, that's the only reason you should go already. Michael, I think you did a great job. It was fantastic talking to you. Thank you so much for sharing everything, walking us through so many moving parts. Asia is, for many of us, a far from my bed show, so this will definitely help many. To our listeners, if you're not subscribed already, go check out Michael's newsletter, The Asia Economist on Substack. I'll make sure to put it in the description and tag it in the wherever we'll post this. And I think it's one of the best ways to stay informed on what's going on in Asia. So, Michael, thanks again.
Thanks so much, Sim. It's been great fun.
Awesome. Talk to you later.